Hey everyone. I think we're going to be talking about VC investing. Things have changed quite a lot over the last 6 months. Why don't we just quickly start with super brief introductions, Kelvin?
Sure. Yeah, I'm the co-founder of Spartan Group, and I focus on the investment side of our business where we have a hedge fund and 2 venture funds. We also have an advisory business that works with some of the biggest crypto firms to help them raise capital, do M&A, and do restructuring.
Hi everyone, Mint here from Ethereal Ventures. Ethereal was set up by the former investment team of Consensus. We've all been working together since 2018, and we're a generalist crypto fund that's more focused on infrastructure. Some of our investments include EigenLayer, Aztec, and Flashbots.
Hi, my name is Lasse Clausen. I'm one of the founding partners of 1KX. We're an early stage token network firm. We started in 2018, first fund to focus exclusively on tokens and the digital assets themselves, and have invested in the early days in things like Arweave, ZK Sync, Wallet Connect, and Safe.
I'm Asib, managing partner at Dragonfly. We're a global crypto VC fund. You know the drill.
So we did a similar panel like this in Singapore like 7 or 8 months ago, and it seems like everything has changed. We were talking about bear market, about allocating in a bear market, and now prices are probably 3x from there. How have things changed in terms of what you guys are seeing in the market? What are the valuations looking like? How are things different than they were 7 months ago, and why was it so quick in terms of transitioning to that period? We can maybe kick off with Lasse, who was on that panel as well.
I just think the number of scams that has just absolutely skyrocketed again. It was really just shocking. Particularly, I was in Hong Kong recently, and the number of deals and projects that are raising is phenomenal. So we're missing out on a lot of stuff right now, which is usually quite hard. The good thing is at least we've been investing very, very aggressively since like 1 quarter before the FTX collapse. So not like timed it perfectly, but things already look pretty bad after the Luna crash. And so at least we are, we don't have so much FOMO because we allocate a lot of money at very low valuations. But now I think it's like a very dangerous time because you really quickly have anything decent being immediately bid up to one project, I won't name it, but we were talking about a 200 million valuation, which was already like kind of like frothy. And then someone offered them a $1 billion valuation for a seed deal. And we're like, okay, this is great for you guys. And
What deal is this?
I'm not going to say it. But,
what is it? Does it rhyme with some?
Stanford professor, the whole thing, and it just.
Okay.
And we're like, okay, this is wonderful for you guys, but that's insane. So it's difficult now. It's because it went so quickly, right? It was really, we're all depressed in a bear market, and then boom, okay, we're so back, and yeah.
Maybe Kelvin, for you, how is the strategy different in terms of deploying? Like, are you doing as many of deals as in the bear market, or is it roughly similar, just higher valuations?
Yeah, so we were active throughout the entire bear market because obviously we have dedicated funds, and to me the bear market was the best time to invest, right? Because that's when the founders find it more difficult to raise capital, and you have a little bit more negotiating leverage. So we've been investing throughout the bear market. But we also knew that the market wasn't going to stay in a bearish environment for a long period of time. And when crypto moves, it moves very quickly, right? So we were basically trying to deploy as much as we can. But in a bear market environment, obviously the deal flow also dries up because generally if the founders have a choice, they don't want to raise in a bear market. So I think the environment certainly has picked up since 4th quarter of last year. And similar to what Lasse was saying earlier, we're seeing certain deals now, particularly in the infrastructure space, where the valuations are getting quite frothy, to be honest. There was a deal recently where, we were asked to put in a term sheet. We did at once. The founder came back and said, this isn't going to cut it. We went back to the investment committee, negotiated for a higher valuation, went back again, still didn't make it, went for a 3rd time, and ultimately somebody else came in and bid it at 50% or 60% higher valuation than we did. So it just gives you a sense of the environment. Now, that's not to say that the entire crypto space is like that. There are certain areas, particularly I would say at the application layer, where deals are still priced quite reasonably, and the fundraising environment is still tough. So we're trying to focus on areas that make sense from a risk-reward perspective.
Min, what sort of deals are you guys seeing now that are the most interesting, or maybe the most appealing for you guys in this market?
Yeah, so we have a focus on pre-seed and seed, and I think this is the area where we maybe haven't seen, I mean, seed is quite competitive, but a lot of pre-seed, because of how early it is, you are buffered to some extent from some of the valuation increases that we're seeing. And for us, because we're more private VC focused, like good companies are built in bull markets and bear markets. We can't try to be overly cute and time the market too much. And I think ultimately you just have to look at the founders and see, are they long-term? Like, do they have strong execution ability? Like, all these fundamentals matter. But sometimes actually funding something in a bull market, even though you're paying a higher price, if the timing works out where you get good adoption, you get more experimentation, more people coming on chain, it's actually better than funding something in a prolonged bear market where you don't actually see as much net new capital coming on chain. So for us, we're still very much focusing on the pre-seed. I think where we're seeing some frothiness and it's total market, rational market behavior is in pre-launch tokens where they're expected to launch in this cycle and hit the cycle narrative. So a lot of people are paying for that liquidity, that ability to harvest in this cycle. For early stage players like us, we're trying to be a lot more disciplined and think about the narratives that will be popular in the next cycle instead.
I want to talk a little bit about meme tokens, maybe Hasib.
Wait, why me?
No, but it's related to, so the way I see it, so much of the price discovery in the last 3-4 years has happened in private markets, right? You see layer 1s, layer 2s listing at $10+ billion valuations almost constantly these days. And normal people outside of angel investors just don't have access to those deals before they actually go public. Do you think that the byproduct of that is that so much of price discovery and so much of the upside actually happens in the VC markets, in the private markets, is that meme tokens are now so popular that maybe normal people feel like that's the only way to actually make it or to actually collect the upside, because so many of the interesting projects already are trading at 10+, and maybe the upside isn't as interesting?
Okay, so I guess that's one theory you could give for why meme coins are popular. I think it sort of explains too much. I think a much simpler theory for meme coins is that every cycle there's some speculative game that people want to play, and meme coins are the current speculative game that is high turnover, it's really fun, it's very social, it's easy to understand. NFTs, in a way, were a kind of shitty vehicle for that speculative frenzy because they're not very liquid by design. They're constrained to only 10,000 people can play the game for any particular asset. If it's 10K PFPs, OpenSea was taking a 2.5% cut on every single trade for the entire cycle. That's kind of an insane tax on the entire system. So if anything, if you want to just go on chain and play some big kind of casino, it is more efficient if it's just a picture of a dog and some tokens than oh, we have to pretend that we're doing art and we have to tell this big story and we have to only have 10,000 and OpenSea you have to get on MetaMask and use OpenSea and all this stuff. And so in some level, if you assume that more or less what's happening in meme coins is a more self-conscious version of the same kind of speculative game that was happening with NFTs over the NFT boom in 2021, 2022.
I think it's a different section of the market. It's really sort of, every culture has these sort of socially accepted little gambling games. In Europe, it's like bingo. It's mostly old people that play it. It has an element of chance in there, right? There's tons of these little gambling games, and I think crypto can also cover that with meme coins. And then generally, if you talk about gambling or lottery, the quicker the turnover is, the better, right? And that's what Hasib said. This is really these things, it's a little piece of internet culture that you can bet on a weekly basis, right? It's 1 week it's this one, the next week is this one, versus that's already and the purest form of that is a slot machine, right? Where every 30 seconds you have the turnover, oh, did I win, did I not win, versus the lottery was always a loss against that because it takes a whole week for everyone to kind of find out if they won, or months.
Yeah.
And so I think it's just a totally segment of the market. And then there's this nice element of, it's basically internet culture that you're betting on, right? It's really just can this become a meme? And then can that also be translated into some speculative game? But I think it's just very, very different from a more professional kind of mindset of, okay, I'm betting on futility and I think I can outsmart the market because I understand the technology better, etc. Very different segment, yeah.
The thing that I'll add as well, so what you're describing of oh, people don't feel like they can get access to the upside of venture investments and so they do meme coins. The way, if you remember in the last cycle, in the DeFi boom, there was this very popular concept of what's known as a fair launch. And this was increasingly becoming the way that people were trying to do the same fundamental story, right? Disintermediating VCs, giving access to the same upside to the normal folk. And fair launches quickly fell out of favor because they all were kind of disasters for the most part, besides Yearn. Yearn was the OG, and then Andre Cronje, of course, the originator of that. And then after that, most of the fair launches, quote unquote, were just complete, just it launched and then it immediately crashes because no one's incentivized to actually build the thing. And so, ironically, in meme coins, there's also this concept of a fair launch. Okay? But a fair launch in meme coins actually does not mean the same thing that fair launches used to mean in the DeFi era. So in the DeFi era, fair launch means no pre-mine for anyone, right? Everything is open access. You just get in there, you yield farm, you mine, whatever it is, and you can get access to the token. In meme coins, a fair launch means no VC allocation. But there's still a pre-mine. The pre-mine is for the team. But in meme coin land, this is what's called a fair launch. So the reality is that the meme coin game is still quite extractive. Like, there are teams that are just professionally going out there. I mean, at this point, everyone knows this. This is not a secret. That there are teams that are going out there just launching meme coins every single day at massive, massive scale, playing all these games. People saw it with Slurf. There's this viral meme coin that obviously they accidentally burnt the LP, and it became this fun, story by happenstance. But the guy who originally made it, what people, token sleuths later figured out, the guy who originally made Slurf, the viral meme coin, he originally deposited his own money into Slurf to give the impression that people were depositing money to try to mine the thing. And like he was basically gaming the thing, and then he fucked up and burnt his own LP. And so the idea that meme coins are somehow not extractive, but VC investments are, I think is wrong. Every market is going to be extractive at scale. The job of a VC is to find things that are good. But I mean, the ultimate person you have to blame for retail investors not getting access to venture investments is the SEC.
Of course, yeah.
But I also want to add a point there. But I think one of the problems that sort of accentuate this, right, is that the media sort of plays on this popularity notion, right, where they talk about the one or two coins that generated 100x returns, right, or 1000x returns, but they don't look at the other 99 or 98 coins that went to zero, right? And there are a lot of those things that happen. Right, and so people sort of come into the game thinking that they're going to get the same kind of returns, but by the time they get in, those returns don't exist, right, and they get burnt.
But in general, when let's say you make an investment and the investment is a $50 million round and it lists at 10 billion and trades there, is that a problem?
I think so, yeah. Because at the end of the day, at least what we try to focus on is really ecosystems and networks. And what that literally means is that you have a large number of the right stakeholders that are actually using this network, that are suppliers on this network, that the ownership is distributed amongst. And it's still, I think the biggest challenge in this space is actually being able to distribute that to the right kind of people. What makes it a little bit better if your product is live for quite a while and then you have a lot of data on retention, etc., where you can try to at least airdrop it to the users that are occurring, which also is extremely gameable at the end of the day. So I still think the biggest challenge is really finding a way that you distribute it because what you're trying to do is you're trying to bootstrap a network. And that also, by definition, means that you have people that put more value in than they extract out. That's the only way that you're creating value in a network. And so it's extremely hard, but extremely important as well, that you actually manage to distribute your token among those type of people. And it's the biggest challenge, really, that we see in the space. Yeah.
I would say also, I mean, what your question implies is that maybe what people should be doing is they should list, instead of at 10 billion, they should list at 1 billion, and then people can buy the token and then write it up to 10 billion, right?
Right.
The reality is that if the fair value of an asset is 10 billion or whatever it is, if you list it for 1 billion, it will go up to 10 billion in 10 minutes, right? And so like the people who will ultimately end up capturing that delta are the people who are trading on Binance in the first 10 minutes, right? Which is not you, or at least not me. I mean, I don't know about you guys, but so the reality is that there is ultimately no way to solve the problem of that the market is really bullish. And now, the way that you mechanically try to solve this is with airdrops and giving a community an incentive. And I think people also, maybe draw too strong of an inference, and they say, well, if you look at Solana, right? Solana obviously has this amazing story. Originally they were super high flyer in the last bull run. FTX collapsed. Solana kind of had their valley of darkness. They went through it. That created a really, really strong community bond within people who are still continuing on in Solana, and now those people are Solana for lifers, right? And like it's very hard to make that. And so you might draw out the argument and say, well, that happened to Solana, so therefore you should list your token at a really low price. That way people make a lot of money, and then there'll be die hard on your token. And I think the reality is that what Solana has is almost impossible to replicate. No one knows how to do that. There is no formula to do it. If you list your token at 1 billion and then in 10 minutes it goes to 10 billion, you didn't create any for lifers, you just made some Binance traders really rich. Creating community is really, really hard. It's really, really hard. Creating people who really believe in your project is really, really hard. And ultimately the best way to get there, like there are individual tactics and tricks and no airdrop this and farm that and blah, blah, blah. But at the end of the day, you have to create a product that's actually useful. And if you don't do that, whether you get a lot of TVL on day one, or whether you come at a very high price, all those things will go away unless you actually have a product that people want.
But I think one of the problems that is causing this inflation in valuation is the question of whether or not there is enough circulating supply, right?
That's
because
true.
you look at many of these vesting schedules, right? The investors, the early investors are locked up for many, many years, which makes sense because they should be aligned with the team and you want investors to be long-term. But then in many cases, you don't have enough tokens in circulation, right? And therefore, the question is there proper price discovery that is happening in the markets?
Yes, so if you're thinking of buying anything, please look at the fully diluted network valuation, FDV. Don't look at market cap, look at full token supply.
I will take the other side
And
of this.
if something has 2% float and is valued at $60 billion, right? Because you want to buy something that's good and cheap. And the way you find out if something is cheap is by looking at the FDV. And so something has 2% float, and therefore it has an FDV of 60 billion is not cheap anymore.
So I disagree with this, but I'm curious. We should probably go around and get the take on FDV because I think FDV is one of the most misused concepts in crypto. So FDV, I mean, I assume most people probably know what FDV is, but FDV is fully diluted valuation, right? Basically, look at all the tokens that will ever exist, multiply by the current price, that's FDV, right? Usually, the current circulating supply of a new token is much smaller than the fully diluted supply, right? The problem with looking at FDV is that FDV compresses a lot of information into one number. And that information includes, for example, how long will it take to get to a certain total circulating supply, right? If you take the FDV of something that's an inflationary token, but it takes 100 years.
Space
to
Mesh,
hit
1,000 years.
Okay, yeah, so some things take 100 years to get to their fully diluted supply. Some things will get there in 3 years, right? Some things, 50% of the supply is community treasury, which basically means that like it is unspendable. It's almost like unissued shares, right? So you actually should be canceling those out because the only time they would be sent out is when it makes sense for the rest of the protocol to actually benefit from those things. Some of them are for liquidity programs, in which case, like again, so you actually have to look into the details to understand what is this FDV representing and how long does it take to get there.
So for the audience listening here and thinking about deploying capital to whatever tokens, like what is the most important metrics that you're looking like? Is it like percent emission each year? Is it like detailed breakdown of where the emissions are going? And is that information even available to normal users?
So almost every token project will give you that chart that shows like the curves. Everyone probably knows what I'm talking about. The curve that like, here's the supply over time, here's the investors, here's the team, here's the like this thing, and the unlock over time. That chart is the chart that you care about. The FDV compresses all that information into one number, but ultimately that number does not tell you enough to know when is that supply coming online, who owns that supply, who are the investors, what's their behavior, right? So if you look at something, for example, where Andreessen, for example, is an investor, okay? Andreessen, most people in this stage know they have super, super long fund lives, right? It's like 13-year, 15-year funds. And they don't care about returning capital to their LPs. And so they'll just be like, yeah, we're going to hold this for 10 years. And as a result, if Andreessen is on your cap table, it might be a very different story than, for example, some random Chinese pump and dump fund is on your cap table, in which case, okay, that supply is getting sold the moment that it comes online. So as an investor, it's kind of on you to think about what does this chart tell me, looking at the underlying composition of what's happening in this chart, as opposed to just, well, FDV is 50 billion, Solana is this much, this is that much, this is not 20% of Solana, therefore it's a bad investment.
Like just to give an example, we have a liquid fund, right? So we have a hedge fund, and we have 2 venture funds. So when we do the venture investing, I mean, obviously we're getting in at a very early stage. It really doesn't matter for us, right? We just need to know what valuation these projects are raising at. But in the hedge fund, where we can invest in these new tokens that get listed, we have to think about these issues a little bit more. And I agree with Hasib in that that one number probably doesn't tell you everything, and you need to look at what the vesting schedule looks like. So there are many tokens out there that we look at, and we know the fully diluted valuation, the FDV, doesn't make sense, but we wouldn't short them, right? Just
Right.
because we know that that supply is not going to come to market anytime soon, right? And in certain cases where we think that there are near-term sort of catalysts that may play out, we may even go long those tokens. So it's not that straightforward.
If it's one number that you're trying to figure out whether this is cheap or expensive, look at FTV. Don't look at market cap. We literally have this now, tons of tokens that have 2% floating, circulating supply. People think it's cheap, and actually the real valuation is whatever, 60 billion. Then definitely go into nuance. If you go deeper than that, you definitely have to look at the things that Haseeb was saying, particularly what kind of investors are in there, what the unlock schedules are. But if it's one number that you're looking at, try to figure out, is this cheap or expensive? Look at FTV, yeah.
I think one thing to also think about is in this market, everything is extremely reflexive. Like, trying to look at any sort of fundamentals, like traditional sort of like price to sales, or even like, just FDV over TVL, like it just doesn't really make sense. But at the same time, you see like, numbers keep going up. There are a few reasons for this. I think you have like very obvious meme coins like the WIFs and the slurs, but even a lot of L1s, like, a lot of just high FDV tokens are kind of meme coins. There's just proxies for retail to get access to something. We're really seeing this with AI, where there are all these like bogus AI projects or anything that has some sort of linkage to like Sam Altman, like just displays of extremely high valuation that doesn't make sense. But, at the same time, like, because a lot of funds and a lot of big investors, you can't actually buy a low market cap token. There's not enough liquidity. So if you see more funds participating on chain, some of them have restrictions. I can buy top 20 coins. It has to be like market cap of above $1 billion. So you then create more network effects within like, those coins that fit those criteria. So in a lot of ways, I think like, just having being vigilant, having a lot of flexibility, trying to make more money than you're losing in this space. I don't know. I'm not a trader, but when we look at the liquid markets, like I don't MMP Kelvin right now, so.
So in bull markets, you guys obviously compete more with angel investors. There's generally just more capital to be deployed. There's now also a new platform that's trying to kind of create syndicates of a lot of angel investors. Is that something that you guys, compete with directly, or is that just something that's kind of supplementary to the rounds that you're seeing?
I mean, every bull market, you see this concept sort of being recycled of democratizing access to investment. And whether, it was AngelList, and okay, they had to be accredited investors, but at least they got like larger distribution. You got ICOs, like, and I get it. It's a little bit, it's regulation. It's Gary Gensler that's basically disallowing anyone from participating in giving folks money, and then depending on them that they create something of value for that. On the other side, like, this is pretty brutal, and it takes a long time. It takes like 3 years. Like, software is very complicated. Crypto software is cryptography is extremely complicated. This takes forever. 90% of the time, this looks like it's just going absolutely nowhere, and it's going to die. You have all these calls with these founders, and 90% of the time, it's just really rough out there. That's why I'm also wondering whether these are really, letting anyone invest. And we saw this at the end with ICOs. It got so overrun by people who honestly just expected that in 1 week this thing is listing at 4x on Binance, and if not, I'm going to yell on the Telegram that I'm going to sue them, whatever. So I get this always. It's a great meme in a bull market that, yeah, you have all these new people coming in, and of course they want the returns that VCs do, but I don't think you see the work that VCs do, which is over 3 years during a bear market. You're dealing with founders that are borderline depressed, that are really, the team is quitting left and right, they're running out of money. Like, this is really hard, awful work, and I think you might not be seeing that. And what you see at the end of the bull market is like, hey, these guys, they made like 50x on their investment. Like, I want that. And of course I understand that everybody wants that. And, we should in a way be able, be open to competition. So every cycle we see this kind of concept coming back in a different kind of format. And it's like, how do you filter for valuable investors? Because even within the VC community, you can get funds that honestly just don't help you. And that applies to anyone. As if you're a project, you really need to get people that are actually helping you and not are sort of entitled and wanting a 4x on Binance next week.
So, oh, sorry, go ahead. No, please.
Yeah, so I think there are a bunch of angel investors in the ecosystem who truly have that kind of network, right, where they've been in space for X dozen of years, and they go to these developer conferences, and they build relationships over the years, right, where they can get access to these deals. But that group is a very small group, and I think some of them maybe in the early days don't have enough capital on their own, and they may sort of adopt this model. I had a guy who used to work with me who started doing these types of investing, and he could get access to good deal flow. But the moment he sort of clips one deal and he realizes that he can do this, it quickly became apparent to him that he's much better off deploying his own capital than trying to aggregate capital from other people, right? So I don't think the model is very scalable, especially at the early stage that you're playing in and the kind of check sizes that people are deploying. And the other point, sorry, to also add is that, I think people sort of invest thinking that all you need to do is provide capital to these projects, but increasingly what we're hearing and seeing from many of these early founders, they don't just want your money or even just your brand, but they want a lot of help from the VCs that invest in them, whether that's through helping them with partnerships, helping them with marketing, helping them with connections to exchanges, market makers, and so on and so forth, right? So it's questionable whether some of these other competing platforms can provide the same kind of value add.
Yeah. I mean, the thing about venture capital generally is that everyone's money is green at the end of the day. And so on some level, the job of a VC is the job of branding money. So how do you make my money worth more than someone else's money? And if you're an angel investor, you have that problem doubly because you don't have the scale to be able to say, wait, great, I'll handle at least all your fundraising needs, so I'm your one-stop shop for your fundraise. If you're an angel investor, you're like, well, you need me and like 5 other angels and then to actually go find a lead investor. So I think it's doubly hard to find a way to make your money more valuable than anybody else's money. And the work there, like you said, is around value add and figuring out how I can be of service to the founders that I'm interacting with. A lot of angels are value destructive, as you said. Like, it's only ever angels who run around saying, I'm going to sue you because you didn't ship the thing on time or the price went down or whatever. And on some level, I don't blame these people. They're scared. They've lost money. They can't afford to lose. And the value add of a VC is oftentimes the fact that they're pros, right? We do this for a living. Like, if a startup in our portfolio fails and they fail for the right reasons, it's okay. Like, we expect, the startups are hard. Most startups fail. Most crypto startups fail. So it's normal that somebody builds something and it doesn't end up going anywhere in the long run, as long as they made a good faith effort to try to get to that finish line. But I think, to most people who think like, hey, if I get into investing in crypto, I'm also going to make 100x's and 50x's and whatever. The other dirty secret of venture is that most VCs don't do that, right? So like, you're seeing on stage 4 very well-known VCs who are running very successful funds on a relative basis. Most funds in crypto do not do well. Most funds in crypto invest in projects that are not the famous ones that you've heard of, and they don't end up getting the really great returns. So it's hard. It's hard to be a good angel. It's hard to be a good VC as well. And the only way that you can really do it is by just being of absolute service to the people who you work with.
Yeah, we have 26 people working their asses off 7 days a week. I'm constantly worried that they're going to burn out. Like, really, like, this is really, really hard work. And there's 26 people that are doing this on different areas, from engineering to financial math to dealing with the exchanges, dealing with the market makers. That whole listing process is absolutely brutal. So a friend of mine, he's a founder. He played college football. He tanked a startup. He successfully sold a startup. Like, he's almost done it all. And he said the hardest thing you will ever do in your life is launch a token. Like, you don't understand how complex and brutal that is. And so you really need like support for that. And it seems from the outside, it all seems really, really easy, but it's a lot of really hard work.
We flipped the page a little bit, looked at top 20 tokens this morning, and I think 19 of them are layer ones. If you look at top 50, I think there's only like 4 application layers in top 50. So when you guys invest, like, if I'm in your shoes, I would think, yeah, it's just another bullshit layer 1, but hey, it's guaranteed 100x because they all accrue value really well. How do you guys navigate that? Like, looking at the potential return and effectively, like, in some ways almost guaranteed, but at the same time knowing that there's so many layer 1s, a lot of them have no activity, and maybe it is the application layer that should be funded now so that we actually bring in users that use these blockchains, use these layer 2s. Is that something that you guys think about, or is it just purely like return-based investment?
I think if you are a venture investor and you have a utopian mindset about how you're going to allocate capital, you're going to die very quickly. So now, that is not to say that you shouldn't be thinking about these kinds of things. You absolutely should. And it's not to say that infrastructure investments are obviously better than application investments. That's not true. It depends on your entry price and depends on the possible return multiples, right? You got to do the math. It depends on what you're paying and what you think you can get. It sounds like the kernel of your question is almost like why? Why are L1 valuations so high? Is this a bubble? Are we in an L1 bubble? Is this going to go away? Can you bet on this continuing to be the case? My answer is more or less yes. I think that it is correct for L1s to be valued very highly because the prize of being a winning L1 is absolutely massive, right? It's like asking the question, does it make sense for Snapchat to be so valuable when they make almost no money? You know, they're losing money. Does that make sense? Well, the answer is, well, if they become the next Facebook, then yes. Right? If Facebook loses young people and Snapchat ends up taking it up, then it's going to be incredibly profitable. But right now, it's not. And so, of course, it's a small fraction of what Facebook is worth. In the same way, some layer 1 that's number 50 on CoinMarketCap has very little activity compared to Ethereum or Solana. It's also valued at a very small multiple of Ethereum or Solana. And so, on a relative basis, it's more or less a parallel argument. It probably will be more clear in 5 years who actually has a shot of becoming a dominant L1 and who doesn't. But right now, I think it's still early. And I think it's a large part of the reason why the market is pricing things as probabilistically as it is.
So I think it's also a chicken and egg problem, right? Because I think some of the larger Web 2 applications, who have interest in Web3 and have looked at Web3 stack would say that, hey, actually the infrastructure isn't quite ready. I can't build something that scales to hundreds of millions of users, right? And I'm not going to do anything in Web3 until that infrastructure is ready, right? So if we don't invest in the infrastructure, then you're never going to attract all of these millions of users and all these application developers that are going to build great things, right? So the infrastructure has to be there. But at the same time, if you don't have users, then infrastructure is going to be worth nothing, right? But obviously, venture investors are always optimistic. We have to be, right? It's part of our business. And so I think that foundational layer has to be built. I think it, as Hasib said, it makes sense that they're valued very highly because the TAM is huge. But I also think that there are, in every cycle, money that goes into these application layers, right? If you look at the last cycle, there was obviously a lot of money going to NFT projects, a lot of money going to gaming projects, and also DeFi projects. And I think we'll see the same thing happen in this cycle. And then for ourselves, obviously, we have two dedicated venture fund. One focuses on DeFi, the other focuses on gaming. And so we're also aggressively investing in those areas. And my hope is that in this cycle, we will see a repeat of what we saw in the last cycle, where a couple of application layer projects do very, very well and attract a lot of users, and their market cap grows, and then that brings in the VC money, towards the later part of the cycle.
One more thing I would add, I don't want to speak too much, but I think there's also a little bit of a category error in the framing of the question, which is, well, if there aren't tokens in the top 50 that are applications, then aren't we overbuilding infrastructure and underbuilding applications? The reality is that if you have a chain that people actually want and that they use, a lot of the applications for crypto, they don't require tokens, right? Like if you want to trade or move stablecoins around or send assets or trade on Uniswap, there's no new token that needs to get created and go in the top 50 for that to happen, right? The reality is that we already know what the killer apps for crypto is, right? Like stablecoins, DeFi, moving assets around. We already have this stuff. We don't actually need another thing in the top 50 to justify why we need more blockchains. So the question of, do we need all these layer 1s? Probably not. We don't need 50. But each of these blockchains is trying to be a better version of what we already have. And in that sense, we clearly do need better versions of what we already have.
Yeah, so the product market fit basically question, which is really scary, is solved, right? We know that we need this. We know that we need this at scale. And yeah, it's an asymmetric upside there. Then also, you're guaranteed that it's basically a meme that works. Sort of, I think also from I would say, there's a broader. One thing as an investor, you're if you're purely rational, you're not investing in. If it's a beauty contest, you're not picking the girl that you think is the most beautiful one. You're picking the one that you think the rest of the judges thinks is the most beautiful one, right? And so you have to consider that as well when investing in the space. That you might think this is the best one, and everyone else is missing it. But if the rest of the market never comes to see that this is actually the best thing, category, whatever to invest. And therefore, the L1 thing makes it easy because, okay, the rest of the market already thinks this is the winning kind of category. You have to, consider that or weigh that with the fact that, for example, we have like very long-term investors, and the reason why they mess in us because they think there might be actually something real in this space after all. Eventually, like this will actually have some like real utility. And so this, it's very embarrassing for us to invest in something at high valuations that just nobody ever uses, right? And so you do kind of want to combine this acknowledgement of what the rest of the market thinks is valuable, and that might not always be based on any fundamentals whatsoever, but you also want to have something where you think, okay, over 5 years, and particularly in bear markets, the traction, the usage of this thing is actually growing. So we try to weigh these things sort of against each other.
So one last closing question, so running out of time. For everyone in the panel, which application do you think currently has the largest chance to actually bring in a lot of users to crypto? A lot of users that are not currently using crypto. Can start with Kelvin.
Yeah, I would have to go with gaming, just because I think the number of gamers globally, that's a pretty huge pool. And I think that the next versions of Web3 games are going to get to a quality level that's pretty good compared to the Web2 games, and that will start to attract more users into the space.
Cool. Good.
We think there's going to be an explosion in payments. Already we see a lot of people using stable coins as a transfer mechanism for cross-border payments, also for settlement currencies. I think you'll also start seeing neobanks start offering it to retail users, and merchants will start saying like, hey, I can actually lower my interchange, like maybe let me start accepting USDC. And I think it'll be really cool because how many times do we pay for things a day? It'll just bring a lot of users on chain.
I think the final form factor, we can't predict it. It's the same thing, Reddit and Twitter, nobody kind of foresaw that. It just took the existing concept of reading news in a newspaper, and there were funds that invested in companies that create PDFs for newspapers so people could read the PDF, but you should have gone straight to Reddit and Twitter. So I think the same way that an existing format is going to be reinvented in a completely different form factor, and we don't know yet what it is.
I would +1 to Min. I think stablecoins will take over the world.
Tether is like the most profitable business in the world right now. It's crazy.
Yeah, it's phenomenal.
Cool. Well, ran out of time. Thank you for everyone for listening. Thank you for the panel. I think it was a great discussion. Appreciate it.